So, any successful and decent investor will tell you that in order to make money trading or investing, you should not try to predict the future like a lot of gurus try to do or try to make you believe they do. The money in this business is in making educated guesses and managing risk. So I'm going to show you a trade where I was spectacularly wrong about the direction of the asset, but it didn't matter because I had good risk management and sophisticated tools. And with those, I am able to make money on that trade that went awfully wrong for me. And I'm going to show you how. So, this is what I was looking to trade. United Health, this was around the beginning of February. United Health had good implicit volatility. And so I thought of selling a put here on the 500 and buying a put option here in 490. And the price of the stock was 528. So I had a good cushion there to protect me. And that trade would give me $200 around that. So if you don't know a lot about put options, basically, I would make money if the price of the stock ended up in March, here, this date, March 21, above 500, then I would make money. If the price was below, I would lose at most $1,000 because I bought this protection here. This blue one at 490 is my protection. So in short, I was if the price went below 500, I was going to have to buy the stock at 500. Doesn't matter the price of the stock 1 month from this operation, but I could also sell the stock at 490. So I was trying to make $200, 210, while risking $1,000. But let's see what happened right after I placed this trade. Here we go. A lot of news. Basically, United Health was suspected of fraud, and also they fired their CEO out of the blue. So the stock plummeted. And by the way, let's cheer for the banks that recommended selling United Health after 1 week after all the bad news. So yeah, that's how far recommendations from your broker or from your bank will get you. So here is when I placed the trade. Like it looked good. I saw that the price kind of gravitated a little bit above 500 and it quickly rebounded if it went under. So I placed the put spread on the 500 level, but then the price started to fall and I placed another put spread and also a call spread above the price. So if the price kept falling, at least I would have some profits. And then the price went crazy. Just look at this. The price spiked up right after I put my call spread, meaning my call spread was losing a bunch of money. And then the price came just melting down. And that's where we are today, around 300 for the stock for United Health. And I'm going to show you everything I did, what was the rationale behind each operation, and how I managed to make money when everything went against me. So let's go to the next slide. So, catastrophe with a little cat, which is very hateful towards cats. Why not dogastrophe? But anyway, so the price of the stock went from around 500, or at least that's where I placed my put, my where I sold the put, and it went to 300, meaning a 40% loss. So, and this happened more or less around the time of the tariff crisis. So, the SP 500, NASDAQ index, everything went down after United Health went down too. So, I have other operations in other assets And that means if I had just sold a put, I could, I was vulnerable. I was open to a margin call because everything was going down. It was not just United Health, but United Health was like a big loss and the stock is expensive. But since I traded a spread, $1,000 would be my maximum loss. So that's lesson number one. Limit your losses. If the stock is too expensive for you to buy, it's always good to have like a little insurance. So here are some options to manage a catastrophic mess like this one. First, you can double down. So United Health is a good company. It has good profit. It is huge. It's probably not going anywhere. It's just a temporary crisis. So one of the things I did was double down. When my first spread was taking losses, I opened another put spread because I figured, well, one of them is going to be successful, right? Or at least I can buy myself time and I can generate a little bit more cash to manage this position. So that's what I did. I doubled down. I doubled my risk, but I also had a little more profits to help me manage this position. Another thing we can do is a dual hedge, meaning if my position is dependent on United Health staying where it is or going up, I can also open a position above the price that will profit if the price stays where it is or if it goes down, which is bear spread with calls or even just selling a call above the price. And there's also the option of changing the underlying. So you just take the losses that you have in one underlying, and then you sell puts or put spreads or calls or call spreads in other underlying. So for instance, I did sell puts on the Nasdaq index because United Health was obviously going through a crisis. So I thought I could, manage my position by changing the underlying asset. So I'm going to show you what that looked like in since February. Here we go. So all the arrows, they are trades I placed more or less in the price that they were placed in, right? So at first, the first arrow, of course, is the first bull spread. And then I double down when the price, came here to below 500. And I also opened a call bear spread around here. So I would make some money, didn't matter what the price did. So the price did a lot of things. And then after it went really crazy, I don't remember exactly what happened with the bear spread. I don't know if I was able to close it at a loss or a profit, or at least one of the bull spreads. I think I closed at a profit, but still I had a lot of losses going on. So right around here, I traded. I kind of traded half of my position to TQQQ put, naked put that I sold, and this is like the Nasdaq but leveraged three times. And the price of this is very low. It's like it was 60, around 60 or 70 when I sold this put. So it doesn't take a lot of my buying power away. And it's also very safe because even if there's a crisis, we all expect the Nasdaq to eventually go up. So it's easier to manage. And what happened in the end here is what I'm going to show you. And it's what motivated me to record this video because this is almost magic. So remember, the price went from above 500 and it's now currently at 300, 40% loss. And if I owned the stock, I was going to be down $20,000. Or if I just sold the naked put, I would be down $20,000. But since I trade mostly spreads, I am down $1,000. Of course, not counting the other spreads I did. I only have one spread now in United Health, and this was the one. This was the one I had in 490 and 480, and I was able to close it for 999, meaning just the underlying value, the intrinsic value of the puts, right? That's the max loss. But I was able to sell a new spread plus a call for 10.35. So I made a little bit of money. And it's not a lot of money because I wanted to play it safe and I have other put and put spreads and call spreads in other assets, other underlyings that are making me money. But I wanted this to still generate a little bit of money for me. So I closed this spread 490, 480, and I was able to roll it down, way down to 360 and 350 and sell a call at 410, which is delta 5, meaning there's only a 5% chance that the price of the stock will actually touch this level. So why is this magical? Because I was able to change the strike price of my put options crazy down. I went crazy down, and this gives me a way better shot at just finishing this whole operation. But even if I don't, I still have a little bit of cash. So when these new options expire, I still have a little wiggle room to still try to roll the spread a little bit down, to roll the strikes down. So I can eventually, this all can be worthless, and then I can finish my business with United Health. So now I have this bull put spread at 360 and 350, and this call at 410. So what are the possible outcomes for all of this? If the price stays the same, then my call will be totally profitable, and I will be able to roll the puts, to the same strike, or ideally putting the strike a little bit down, and maybe I will sell another call to help bring the strikes down of the puts, right? So this is not a bad scenario, and it's the most probable scenario because I think everything that had to happen to United Health happened, and now the market's kind of stabilizing. And when we sell options, we mostly expect the markets to stay the same, which is what they do most of the time. Another possibility is that the price of the stock goes down, it keeps going down. So again, my call will end up being totally profitable, and I will try to lower the strikes of the put spread. But if it goes down, I can sell calls next to the strikes of the puts, and make a bit more money, maybe a little bit more money. That will help me again to roll those puts and lower their strikes. Or if I think the situation is hopeless, I can take the losses that I had in United Health and sell puts on SPY or Nasdaq or something like that. I can change the underlying. And what I'm hoping for, if the price goes up, not by a lot, but above my put spread, then everything I sold will end up becoming worthless, and then I will have maximum profit, and I will land my operation in United Health. So if the price goes above 360 but below 410, I will have maximum profit, and then I will decide what to do next. Maybe United Health, or maybe I'll seek other stocks. Doesn't matter. But that will be the ideal situation. Now, there is the possibility, the very remote but real possibility, that the price just shoots up and blows up this 410 call. So then I will have a maximum profit on the puts, right? And then I will just start to manage the call side of the operation. So if the price comes too close, I may buy a call above this one I sold to protect me, or I may roll it up and open another put spread to help roll it up, and I will stay in the game. But the important thing is to always make money whenever I roll those operations. Because, like I said, we cannot predict the future. We can only make educated guesses and manage risk. So, everything I'm doing here, I have the risk of the operations in mind. So, I didn't sell a naked put to start it because this stock has a very high price. So, like I said, I would be $20,000 in the red if I had just sold a naked put, or even if I bought the stock directly. So I operated a spread. And now I sold this naked call, but it's so far away from the price of the underlying. And if it gets here, I will have a maximum profit on the put spread. So you see that there's a very real possibility that this will keep being a profitable operation. And I can even be more aggressive. I could sell calls closer to the strike of the puts. But I didn't because I want to play it safe. But I'm still putting a little bit of money in my pocket each time I manage this position. So that's the lesson here. Predicting the future is not good business. Good business is having a very tight risk management system and having the tools to manage your positions, to have different alternatives in case different and weird scenarios end up happening. I hope this was useful. This is a little bit different of what I usually talk about in this channel. So if you like this, if you want me to talk more about investments and especially derivatives and options, I love trading those. Let me know in the comments. And if you liked this video, you'll love the next video that's appearing on your screen. Subscribe, keep watching. See you later.